Dear investor, quarter one result season has ended. The result season again saw companies which represent the newer growth spaces in the market deliver much stronger numbers versus the indices. This sustained strength in relative earnings should be a key driver for alpha in our constructs over time. US trade issues should have a much better outcome versus the present. And of course, we will talk time for alpha and the thought that high beta constructs may prove to be better for performances focused investors. Index funds, aim to replicate the performance of indices, while active funds seek to maintain a high active quotient. A portfolio of long constructs make you hold the entire market. A focused construct may be better. Sustained growth may offer opportunities. Size does not always provide safety. Valuations in certain segments have undergone a correction. US trade issues should have a much better outcome versus the present. Let's talk on that. US has put a 25 plus 25% tariff on India. Now, thing is, except pharma and electronics, which are excluded, other exports from India in spaces like textiles, leather, and shrimps are de facto denied entry. In spaces like steel, aluminium, and copper, the duties are 50% across the world, and companies are at par. At current juncture, the impact on the market is limited, as spaces which are impacted have only got a marginal presence in the market and economy. And if we believe that the global demand and supply can't be changed very quickly, then in most cases we expect shifts in target market versus permanent damage, especially if the issues can be resolved in due course. We are the fourth largest market already, while our per capita incomes remain low. As our incomes rise, we would be one of the top three markets globally. In many spaces such as defense, energy, food, we would be the largest importers in the world. We could be the largest importers in the world. A partnership of large economies, large markets may prove to be mutually beneficial. On our next thought, time for alpha. Well, this is something that we have been sharing for over 2.5 years now. Let us start with a simple belief that markets follow earnings growth. Hence, one needs to find spaces that can deliver strong growth in earnings for several years, which could potentially result in alpha. Such opportunities are often seen in relatively younger sectors that are less burdened by overall size and growth dynamics of the economy. In the 90s, the combo of high growth sustaining for longer was delivered by software, for example, and later in the early 2000s by private sector banks. In the same light, we think newer spaces in the market, such as capital market participants, brokers, mutual funds, etc., new tech players offering large operating leverage, renewables, electronic manufacturing, EVs, spaces like GLP-1s in pharmaceuticals, hospitals, luxury are being currently observed for their growth potential. This quarter again, the experience was the same as the table below shows. Many of our investee companies had a strong quarter, beat expectations, and overall, the portfolio growth in earnings achieved was significantly higher than the index earnings growth. At Motilal, our funds have a large presence of newer growth-oriented sectors versus legacy sectors. We believe that the country embracing change and innovation, newer sectors are expected to play an increasingly important role in the economy over time, though outcomes remain subject to market risks. High beta constructs may prove better for performance-focused investors. Beta is a measure that reflects how strongly a stock price tends to move in relation to the broader market's movement. For example, if the beta were 1.5 and the index moved up or down by 1%, the stock would have moved 1.5% on an average and vice versa. Typically, beta changes over time, and that's a challenge. While general belief is that low beta constructs are better, since this indicator comes in higher focus when markets are down. However, since over time markets have tended to move higher, for a return focused investor, sustained good higher beta constructs may involve higher risk along with potential for strong performance. May turn out to be better. Higher betas on account of sustained earning growth can be seen as good beta, as our belief is that market often follows earnings growth. However, higher betas on account of, say, earnings volatility or commodity character of business or leverage may be considered bad beta. Endeavor in portfolio construction is to maximize good beta while limiting exposure to bad beta. For example, the Nasdaq has historically displayed a higher beta versus S&P 500 but has overall provided better outcomes over time. Beta tends to get higher focus in periods when the indices are not doing well and is associated with funds that may experience a larger fall in such periods. This can make low beta appear relatively better than high beta. Over longer periods of time, as market typically moves up, the opposite may be true for better return outcomes. Betas for many high growth constructs are expected to be higher, and is the case with us, though outcomes are subject to market risk. Index funds aim to replicate the performance of indices, while active funds seek to maintain or should seek to maintain a higher active quotient. In the industry, consistency of performance, through which we mean performance in a narrow range of index, is often seen as a virtue. However, if an investor is invested in more than one fund of this attribute, wouldn't overall performance remain close to index itself? In such cases, a low-cost index passive fund can deliver this need more economically. Now, yes, high tracking error versus the index can result in sharply lower outcomes also. That is the risk. However, if there is a long-term investment approach guided by data and experience, then the risk of sharp, sustained, long-period underperformance can be considerably reduced. At Motilal, we run funds which are with relatively higher tracking errors. However, the constructs are aligned with our belief that markets follow earnings growth. The earnings growth quotient in our construct is consistently kept high by inclusion of multi-year growth themes. Now, the next thought, portfolio of long constructs make one hold the entire market, and a focused construct may be better. Most investors today typically build portfolios with multiple schemes across fund houses. If several long funds are held together in this approach, the combined portfolio often has everything in the market, it mirrors the market, leading to outcomes again similar to the index, something that can also be achieved with passives cheaper. At Motilal, our differentiator is we believe in focused high conviction fund constructs, which in our view are aligned with the preferences of investors seeking differentiated strategies in today's environment. And the next thought, valuations have undergone a correction. Now look at it this way, Nifty has barely changed over the past 1 year while earnings have expanded by 8%. This points to a significant valuation correction over last 1 year. In a period when interest rates have declined and liquidity has improved, this is even more significant. Now, US actions on trade did impact sentiment, but while spaces like shrimp farming, textiles and leather, which were potentially impacted, these are small spaces in the market. Even for the broader economy, the damage is very contained. Moreover, since setting new capacity takes time and overall global demand and supply dynamics tend to adjust gradually, in most cases, the near-term impact may be more visible on margins rather than on overall sales, at least in the short term. So, more profitable spaces will be taken up by players who are favored by who were fared better in the US import duty outcomes, and less profitable spaces may be taken by others. Now, most of the larger spaces in the index remain unimpacted. However, we continue to be positive on expecting a significantly better deal wherein our exports are taxed closer to 10%, given that we are the fourth largest market globally and also the fastest growing. In categories like defense and food, India could potentially emerge as the largest market, a position unlike most other economies with whom US has trade agreements. Greater access to the world's largest market would also support government's Make in India initiative, and that's something that we look forward to. Now, Indian markets have seen valuation correct, and once sentiment improves, it can result in a period of outperformance. Thank you. May the good times continue, and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.